Israel just bombed Iran's nuclear sites. Iran struck back with 100 drones. Oil surged 14% overnight. Gold hit $3,428. But here's what no one's saying. The US dollar, supposedly the world's safe haven, barely moved. ING called it a stunning deviation. Wall Street pulled $12 billion from US equities in 1 week. And here's the twist. Trump gave Iran a 60-day ultimatum. The strikes landed on day 61. So ask yourself, if Washington can't control its allies, can it still contain the consequences? On June 13, 2025, Israel launched airstrikes on Iran's Natanz nuclear site against President Trump's public directive not to escalate. Within hours, Iran retaliated with over 100 drones, and reports from Iranian state media confirm the deaths of military chiefs Hossein Salami and Mohammad Bagheri. Despite U.S. denials of involvement, Tehran issued direct threats against American bases housing over 47,000 troops across the region. According to Reuters, Trump later praised the strike as great for the market, even as West Texas Intermediate crude spiked over 14% to $77.62, the sharpest daily gain since 2022. Meanwhile, the Wall Street Journal reported rising investor unease over America's waning influence, as Israel ignored Trump's explicit warnings, exposing a fracture between diplomatic messaging and actual power. If allies are no longer taking calls, the bigger question is, who exactly is commanding the chessboard? Iran sits on a geopolitical tripwire, controlling the Strait of Hormuz, where 40% of the world's crude oil and 20% of its refined fuels flow. This narrow maritime corridor is now a live target. According to Bloomberg, 11% of global seaborne trade, including shipments from Saudi Arabia, Bahrain, and the UAE, passes through Hormuz daily. While the U.S. produces its own energy, 82.2% of American power still depends on globally priced commodities, per the U.S. Energy Information Administration. Unlike China, which sources over 30% of its grid from renewables and nuclear, America's energy mix remains anchored to oil, gas, and coal. Any Iranian move to obstruct the strait temporarily or symbolically could drive Brent crude well past $90 within days, triggering inflationary pressure that not even Fed hawks can ignore. And if Iran escalates further, the cost won't just be measured in barrels. It'll hit every bond, every ballot, every back pocket in the West. Brent crude shot up 13.2% in a single trading day, closing at $78.50 per barrel, while WTI jumped 14.1%, the largest intraday surge in 3 years. The trigger? Israel's energy ministry ordered Chevron to shut down the Leviathan gas field, Israel's largest, with 22.9 trillion cubic feet of recoverable gas, citing retaliatory threats from Iran. Bloomberg confirmed the shutdown disrupted 981 million cubic feet per day of gas exports to Egypt, a nation already facing a domestic shortfall and now forced to seek emergency LNG at a premium. Goldman Sachs warned that if more infrastructure gets hit, Brent could climb past $100 within weeks. Meanwhile, Jordan's gas flow hangs in limbo, and European prices spiked 6.6% on the news. The dominoes haven't even finished falling. Yet the world's already paying more at the pump. But what happens when the second strike lands? 2 months ago, Trump gave Iran a 60-day ultimatum to strike a nuclear deal. And, well, day 61 brought Israeli airstrikes. The coincidence hasn't gone unnoticed. Despite public statements distancing Washington from the attack, the Wall Street Journal revealed U.S. intelligence was aware of Israel's plans and failed to intervene. Trump's comment that Iran should have made a deal now reads more like a provocation than policy. The oil market reacted accordingly. Options pricing jumped, with traders now betting on $130 per barrel scenarios if Hormuz tensions escalate. ING analysts noted the lack of safe haven flows to the dollar was stunning given the scale of geopolitical risk. Instead of deterring conflict, Trump's timeline may have created one. The question now, was this a failed warning or a setup for something far worse? Reshoring was supposed to bring jobs home. Trump's tariff-heavy plan forecast 1.2 million manufacturing jobs gained by 2026. But according to a Congressional Budget Office report, the U.S. could lose 1.6 million service jobs in parallel. resulting in a net loss of over 440,000. And yeah, that's before factoring in high energy costs. U.S. industrial electricity prices have already risen 11% year over year, and with crude nearing triple digits, the cost of domestic production will surge. A Bloomberg intelligence report warned that companies considering reshoring are now deferring investments due to volatility in fuel prices and supply chains. Unlike China, where plants run on subsidized nuclear and solar, U.S. factories depend on natural gas and diesel, both vulnerable to Middle East instability. If oil breaches $130, reshoring doesn't just stall, it collapses under its own economic weight. And in that vacuum, Asia becomes the default factory floor once again. The S&P 500 shed 2.3% in a single session following the Israeli airstrike, while Treasury yields surged as bond traders braced for prolonged inflationary shocks. According to Bloomberg, institutional outflows from U.S. equity funds topped $12.4 billion last week, marking the sharpest weekly withdrawal since March banking turmoil. Despite rising geopolitical risk, the dollar barely moved, climbing just 0.5%. This isn't flight to safety. It's hesitancy, driven by conflicting monetary signals and fiscal overexposure. With the Fed expected to hold rates steady to contain inflation and Trump's tariff squeezing margins, markets see no exit. As one BlackRock analyst told the Wall Street Journal, "We're witnessing policy paralysis colliding with external shock. Investors are not repositioning, they're abandoning. And with the next CPI print now set to include $4 gas and $100 crude. The only question left is how hard the landing will be, and what breaks first." Gold has now overtaken the euro as the world's second largest reserve asset, making up about 1/5 of global central bank reserves according to the IMF, while the euro has fallen below 19.7% for the first time since 2002. This shift is being led not just by retail panic but by sovereign accumulation, especially from BRICS-aligned countries hedging against dollar-linked volatility. Bloomberg reports that China, Russia, and Turkey have quietly increased gold holdings by 14% in the last 6 months. UBS strategist Mark Anderson told Bloomberg TV, "Gold was the only asset in 2025 that protected against rate stagnation, dollar uncertainty, and geopolitical instability. Spot gold is now trading at $3,428.10, within 2% of its all-time high, with futures breaching $3,450 and options volume spiking. This isn't a fear response. It's an institutional exit strategy. And what central banks are moving into now could soon define what currency stability even means." The US dollar's role as a crisis hedge is unraveling in real time. During the Iran-Israel exchange, DXY barely moved, closing at 104.2, flat despite a major international military escalation. ING analysts argue this marks a structural shift in safe haven flows, citing the weakening correlation between U.S. strength and dollar demand. Meanwhile, gold and yuan-linked reserves surged. China's central bank increased its gold reserves for a 17th consecutive month, while Russia announced it would begin settling more oil contracts in rubles and dirhams. According to WSJ, even Swiss francs and Singapore dollars outperformed USD in terms of capital inflows last week. The old reflex, run to the dollar when the world burns, is losing credibility. And if the global financial community is starting to price risk independently of Washington, then what happens in the next crisis may not be a run to safety, but a silent vote of no confidence. Iran's drone retaliation is only the beginning. Israeli strikes killed senior military officials, including IRGC Commander Salami and Armed Forces Chief Bagheri, prompting Tehran to call for unrestricted retaliation, with the Leviathan field shut down and Egypt forced to pursue emergency LNG imports. Regional supply chains are fragmenting. The Red Sea, Strait of Hormuz, and Bab el-Mandeb, 3 of the world's most critical trade arteries, are now exposed to asymmetric attacks. JP Morgan analysts warn that a full-blown naval escalation could drive crude past $130 and erase third-quarter growth forecasts entirely. Trump's statement urging Iran to make a deal post-strike contradicts intelligence leaks reported by WSJ, showing the U.S. had prior knowledge of the Israeli operation. The nuclear talks scheduled in Oman are now in limbo, And with Iran refusing to halt enrichment while Israel vows continued pressure, the next strike may not hit reactors. It may hit oil terminals. And if that happens, the dollar won't just wobble. It could crater under the weight of its own assumptions. So let's cut to it. If central banks are trading dollars for gold, if investors are fleeing U.S. equities despite conflict, and if energy prices are rewriting the Fed's entire roadmap, who's actually steering this ship? Drop your take in the comments. What happens if Iran's next move hits global oil flows? And is gold just the beginning of a wider asset realignment? Because this crisis isn't over. In fact, the next 48 hours could shift the balance of global finance. Again. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.